Financing is a topic on your exam that's full of unique terms and concepts. I want to review some of those with you and make sure you've got a full understanding and know how to answer the questions when they show up. First two terms I want to go over with you are points and loan to value. Points are charged by a lender to increase their yield on a loan. There's a test answer for you. And also, points are calculated as 1% of the loan amount. If a borrower wants to borrow $80,000, then 1 point would be $800, 2 points would be $1,600. Also, the loan to value is calculated on the purchase price. The loan to value just expresses the amount of money in a percentage that the lender will lend based on a buyer's qualifications and the property and the type of loan they want. But a loan to value of 80% would be calculated this way. An 80% loan to value on a home that a buyer wants to buy for $100,000 would mean that the borrower is going to borrow how much? $80,000, 80% of the purchase price. Here's a little tip on loan to value. Remember this for your exam. Loan to value percentage plus the down payment percentage will always equal 100% of the purchase price. In other words, if a borrower is going to get an 80% loan to value loan, then they're going to put down 20%. Maybe the borrower needs a 90% loan to value. Then the borrower will put down 10%. Good thing to remember for your exam. Loan to value percent plus the down payment percent will always equal 100% of the purchase price for the property. Here's how these two might intertwine in a test question. Follow me on this one. A borrower wants to buy a house for $100,000. They want an 80% loan to value loan. So how much do they have to put down in a percentage? 20% down. But the borrower who wants the 80% loan to value loan has to pay 3 points to be able to lower the interest rate so that the borrower can qualify. So the question will be, how much are those points worth? What's the value of 3 points on our transaction? Well, points are calculated on the loan amount. So the loan amount is $80,000. 1 point is worth 1% of the loan amount. So that would be $800. So 3 points would be $2,400. So the borrower would need $2,400 paid to the lender up front in points to lower their interest rate to get it to a shorter interest rate or a smaller interest rate that they can then qualify for. So a couple of key points about loan to value and points. Very important for you to know who the mortgagor is and who the mortgagee is in this financing section. The mortgagor is the person who gives a mortgage. In our example, who gives a mortgage? The buyer, who is the borrower, gives a mortgage to the lender. In return, the lender loans the buyer money. So it is the buyer who is the giver of the mortgage. Please remember that for your exam. It's often missed by students because it's used wrong in the marketplace. I'm sure you've heard these ads for lenders. Come to our bank and get a good mortgage. That's wrong. It's misuse of the term. You don't go to a bank to get a mortgage. Remember this. You go to a bank to get money so you can buy a house. But what do you have to give to the bank before they'll loan you the money? You have to give them a mortgage. So the borrower is the mortgagor. The lender is the mortgagee because the lender receives the mortgage. Mortgagor and mortgagee. Make sure you have those straight when you take your exam. Since we're talking about mortgages, let's talk about the relationship between a mortgage state and a lien theory state. You've heard about lien theory versus title theory in your coursework. Let's talk about lien theory states first. Lien theory states use mortgages. So let's walk through the process. Our buyer wants to buy a house. They go to a lender. They have to give the lender a mortgage, and then the lender will loan them money. The mortgage is security for the debt. The lender says, we'll loan you the money. However, we need some security in case you don't pay. So the borrower, who is the buyer, gives a mortgage to the lender as security for the debt. If the buyer doesn't pay their mortgage payments on time, the lender can foreclose and take the house. So remember, a mortgage is used in a lien theory state. What other security does the lender have when they accept a mortgage from the borrower? They also place a lien on the borrower's property. So that's why it's called a lien theory state. Lien theory state actually refers to who holds legal title during the term of the mortgage loan. So let's wrap this up. Put it all in a nutshell. This is the way you might see it on the exam. A borrower goes into a lender and wants to borrow money to buy a house. The borrower gives the lender a mortgage. The lender loans the borrower the money. The lender also puts a lien on the lender's property because during the term of that mortgage loan, the borrower has legal title. When your coursework refers to title theory states, that's a little different animal. Title theory states use deeds of trust. Excuse me. Title theory states use a deed of trust. There are three parties in a deed of trust state. There's the borrower, the lender, and a trustee in between the two parties. And it's actually the trustee who holds legal title during the term of the mortgage loan. So that's why it's called a title theory state, because the borrower doesn't hold legal title in a deed of trust state. The trustee holds legal title. And that indeed might be how the question shows up on your exam. They may phrase it this way: who holds legal title during the term of the mortgage loan in a lien theory state? The answer is the borrower. The buyer has legal title. However, the lender has a lien on the property. But in a deed of trust state, it's the trustee that holds legal title during the term of the mortgage loan. And you can find more information about this in my full lesson video on financing on my YouTube channel. So let's recap a few things here between mortgages and deeds of trust, lien theory states, and title theory states. This is important for your exam. A mortgage is a two-party instrument. Just the borrower and the lender are involved. Remember, the borrower, who is the mortgagor, holds legal title during the term of the loan. The borrower has to give the lender a mortgage. They also have to give the lender a promissory note, which is an IOU. We'll talk about promissory notes in just a minute. The lender loans the borrower money to buy the house and also places a lien on the property. So if the borrower doesn't repay the loan, the lender can foreclose on that lien. Now, contrast that to a deed of trust state. Again, to recap, a deed of trust is a three-party instrument. You have the borrower and the lender and a trustee in the middle between the two. And it's the trustee who holds legal title during the term of the loan. Let's talk a little more about the promissory note that I mentioned earlier. Promissory notes are used in both lien theory states and deed of trust states. Remember, a lien theory state is a mortgage state, and a title theory state is called a deed of trust state. Promissory notes are nothing more than an IOU. An Promissory note is evidence of the debt. Good term to remember for the exam. The promissory note is evidence of the debt. Another good reminder is that the mortgage is security for the debt. A mortgage is security for the debt, but the IOU is the promissory note, and that is evidence of the debt. Two distinct things. The promissory note is going to contain several important clauses. They're important for the promissory note, but they're really important for you in your exam. You should know these. I'll recap them for you and make sure you understand how these work. Important clauses in the promissory note. First one is the acceleration clause. Acceleration clause means the lender can accelerate the time to repay if the borrower is in default. Instead of 30 years to repay, the borrower might only have 30 days. So they can accelerate the time to repay. They can call the note due and payable immediately. There's another very important clause you have to know for both a mortgage and a deed of trust. That is the defeasance clause. The defeasance clause says when that loan is paid off, or when the loan is defeated, if you want to think about it that way. In the defeasance clause, once the loan is paid, the lender must give the borrower evidence of repayment. Here's a couple more terms for you. In a mortgage state, the lender will give the borrower a satisfaction. Key term for your exam. In a mortgage state, the borrower gets a satisfaction from the lender when the loan is repaid. In a title theory state, using a deed of trust, the borrower gets from the lender a deed of reconveyance. That comes from the lender when the loan is paid. Remember, in a deed of trust state, the borrower doesn't have legal title. In a deed of trust state, the trustee has legal title. So once the loan is paid off, the legal title will move from the trustee to the borrower, and they'll do that by using a deed of reconveyance. Next important clause in the promissory note is the due on sale clause, or referred to on the exam many times as the alienation clause. Now, here's a vocabulary word for you: alienation of property. Alienation in real estate is any transfer of ownership from one party to another. If I sell my house to you, at the closing, I'm transferring ownership from me to you, and so I have alienated myself from that property. That's where the term alienation comes in. Well, the alienation clause in the promissory note is often referred to as the due on sale clause, which says that whenever the borrower sells the house, and the house is sold and transferred ownership to a new party, then the loan must be repaid. The entire loan balance is due upon the sale of the property. That's why it's called the due on sale clause. Another very important clause in the promissory note is the power of sale clause. That's different now. The power of sale clause. Here's why that's important. The power of sale clause gives the lender permission to foreclose on the property if the borrower is in default. It gives the lender permission to foreclose without going to court. The lender doesn't have to go file a lawsuit to foreclose on the property, as long as the power of sale clause is included in the mortgage. So your exam may ask you this question: which clause in the promissory note gives the lender the right to foreclose on the borrower if they're in default without having to go to court to get permission from a judge to foreclose? Correct answer is the power of sale clause. The borrower gives the lender the power to sell their house if they're in default. Let's discuss different mortgage markets real quick. There are primary mortgage markets and a secondary mortgage market. Here's the difference. The primary mortgage market is where borrowers go to borrow money to buy a house. It is the banks and the lending institutions that the borrower or the buyer goes to get money to buy a house. The secondary mortgage market is where those lenders who have loaned people money to buy homes, it's where those lenders go to sell their loans. They sell them in a secondary market. Now, here's a couple key questions for your exam. First of all, simple one. Where do buyers go to borrow money? Primary or secondary market? Primary market. Where do lenders sell those loans? In the secondary market. Here's a couple other test answers for you. Why do lenders sell loans in the secondary market? They sell loans in the secondary market to replenish cash in their bank so they can make more loans to future buyers. Here's a quick example. Let's say ABC Bank made, in the last 3 months, they made $10 million in home loans. They have loaned out $10 million of their cash so people could buy homes. Now their cash is somewhat depleted at the bank, but they hold $10 million in mortgage loan IOUs, promissory notes, and in mortgages. So they can take those promissory notes and mortgages and sell them in the secondary market at a small discount typically. They can sell them at a discount and recoup most of that $10 million in cash and get it back into their bank. So that's why lenders sell loans in the secondary market, to get more capital back into their bank so they can make more loans to more buyers. The other question you'll see a lot on the exam is, how will a borrower know if the loan that they received from their lender has been sold in the secondary market? If you borrowed money to buy a house from ABC Bank, how do you know if they've sold that loan in the secondary market? Here's the answer. The buyer will receive a letter from their lender saying you don't send payments to ABC Bank anymore. You send your monthly payments to a different party. You send them to a new entity, somebody who receives that money and logs it in. So a borrower knows their loan has been sold when they receive a letter telling them to send their monthly payment somewhere else other than the lender that they borrowed from. That's how a borrower will know. You'll also have questions on the financing portion of your exam about the different types of loans that borrowers can get. 3 basic types. You want to be aware of the fine points of each one of these, okay? We're going to talk about an interest-only loan, a partially amortized loan, and a fully amortized loan. Real quick, and again, you can get more information about these different types of loans on my full lesson financing video on my YouTube channel. An interest-only loan is just that. A borrower pays only interest. Normally they're short-term loans, but interest-only loan, they only pay interest, and so at the end of that loan, and they're typically shorter loans, 3 to 5 years, maybe 7 years. At the end of that term, how much does the borrower still owe? The full amount of the loan. All they've done is pay interest. So it's got the smallest payment and the largest balloon. The other type of loan I'll jump down to is a fully amortized loan. This is the one that's most typical in the marketplace. A fully amortized loan, a borrower pays principal and interest during the entire term of the loan, and when that term is up, there is no principal balance left to be paid. It is all paid off. So a typical fully amortized loan is we'll call it a 30-year loan at whatever the market rate percent is, but over 30 years the borrower makes payments. At the end of the fully amortized loan, there is no balloon payment at the other end. And a partially amortized loan is sort of right in the middle. The buyer pays interest and some principal during the term of the loan. But in a partially amortized loan, when the term ends, there is still some principal balance left to be paid. That's why it's called partially amortized. So recall those 3 different types of loans and know the distinction between each one of those. I want to take a few minutes and review the difference between conventional and insured conventional loans, and then in VA loan and FHA loan differences. So let's start with conventional versus insured conventional. The distinction with a conventional loan is the borrower has put at least 20% down, which means the loan to value is what? 80%. Remember, the loan to value plus the down payment percent always equals 100%. 20% down means it's an 80% loan to value loan. It also means the lender does not going to charge the borrower any private mortgage insurance, no PMI payment at all, because the borrower has put 20% down. So if a borrower is going to put less than 20% down, a lower down payment, maybe 10% or 5% down, then the lender is going to charge the borrower private mortgage insurance. So PMI is paid by the borrower if the borrower makes a low down payment loan, like 10% down. If it's 10% down, what's the loan to value? 90% loan to value. So they may express it that way on the exam. An insured conventional loan is one where the borrower has put down less than 20%, or they may phrase it this way. An insured conventional loan is where the borrower has a loan to value of greater than 80%. Higher the loan to value, lower the down payment. But with insured conventional loans, the borrower pays PMI, very important term. The P in PMI stands for private mortgage insurance. No government agency involved there. Now let's discuss the key elements in an FHA loan. Here's your key testable points. FHA does not loan money. The FHA works through approved lenders. Same lenders a borrower would go to for a conventional or an insured conventional loan. FHA homes must be owner occupied. You can't use an FHA loan to buy rental property. And there can be no prepayment penalty in an FHA loan. Borrower can't be penalized for paying the loan off early. Also, FHA loans, which typically have a down payment as low as 3.5%, also will charge the borrower a mortgage insurance premium, or MIP. FHA loans, the insurance premium is called MIP, mortgage insurance premium. Remember, contrast that with our conventional loan that was insured. Insured conventional loans charge PMI. FHA loans charge MIP. Good thing to make a note of and remember for your exam the difference between those two. And remember, FHA loans are fully assumable by a subsequent buyer if in fact that buyer qualifies with the lender. Now that is FHA loans. Let's talk about the differences between those and a VA loan, Veterans Administration loan. Just a couple key testable points here, okay? There can be no prepayment penalty also in a VA loan, and the down payment on a VA loan for a qualifying veteran can be 0. So if the down payment percentage is 0, what's the loan to value percentage? 100%. In other words, with a VA loan, the qualifying veteran can borrow 100% of the purchase price, no down payment. The other key point is VA loans do not charge mortgage insurance. They do charge the borrower something, but what they charge the borrower is a funding fee. VA does not guarantee the lender, does not insure the lender against losing money, but the VA guarantees the lender that they won't lose money if that buyer defaults. And think of it as the VA being self-insured. So does a borrower pay some money to the VA for that guarantee? Yes. Funding fee is what the borrower pays to the VA when they get a 0 down VA loan. I want to recap for you a couple key elements of what we just talked about between conventional, insured conventional, VA, and FHA loans. With a conventional loan, there is no insurance premium. With an insured conventional, there is an insurance premium because the down payment was less than 20%. And the insured conventional premium is called PMI, private mortgage insurance. With an FHA loan, which typically has a very low down payment percentage, there is also an insurance premium, but with FHA loans, it's called MIP, mortgage insurance premium. And with VA loans, which require zero down payment, there is no insurance, but the VA guarantees the lender against losing money. And for that, the borrower pays the VA a funding fee to get that guarantee. All good word associations for your exam. Another type of financing they'll ask you about on the exam is seller financing. Used very often in the marketplace depending on your area and the different market conditions, but seller financing is something that will show up on your exam without a doubt. So the easiest way for me to share some of this information with you is to use a first-person example. Let's assume I'm going to sell you my house. I'm going to sell you my house with seller financing. Now, seller financing on the exam is going to be referred to as either a contract for deed, a land contract, or an installment land contract. All three of those terms refer to seller financing. But let's make the assumption again, I'm selling you my house on a contract for deed. Let's say you're buying my house for $100,000. You're going to pay me some money down, all negotiable between buyer and seller, and you're going to make monthly payments for typical contract time would be 5 to 7 years. And at the end of that 5 to 7 years, you would pay off the contract for deed and then you would own the house. Here's your key testable points. At the closing table, in the beginning, when you give me your down payment, as the seller, I keep legal title. Seller retains the legal title until the contract is paid off. What do you as the buyer get at the closing table when you give me your down payment? You as the buyer get a contract for the deed. I keep the deed, but you get a contract for the deed. And remember, as a seller, I keep legal title, but do you as the buyer have any kind of legal title to the property? You do. It's called equitable title. Seller keeps legal title, buyer gets equitable title. And here's all equitable title means. I want to make sure I do my best to explain this term. Equitable title, I want you to think of it as contractual title. You have a contract in your hands that says if you make payments to me and meet all the terms of the contract, I must transfer legal title to you. Well, that's contractual title. The legal term you'll see on the exam is equitable title. You could go to a judge. If you met the terms of the contract fully, you could go to a judge and force me to give you title if I decided I didn't want to at the other end. So you have equitable title, contractual title. So when does legal title pass to you as the buyer? Legal title on a land contract passes to the buyer when the contract is fully paid off. That's why it's called a contract for deed. It's a contract for the deed. Okay? And the other key testable point is, what are my options as the seller on a contract for deed if you default on the terms? What if you don't meet the terms of the contract? Halfway through, you stop making payments. What method of recourse do I have? What can I do? Do I foreclose on you? No. Remember that. The remedy for the seller, if the buyer defaults on a contract for deed, is called termination. As the seller, I would terminate the contract for deed. Remember, it's not foreclosure. That's likely going to be one of the multiple choice questions you'll see. What's the seller's remedy if the buyer defaults in a contract for deed sale? Termination is the correct answer. There's two other types of loans I want to make sure you have a clear distinction, because these will be on your exam. A home equity loan and a home equity line of credit. Here's the testable differences. A home equity loan gets paid out in a lump sum. If I have a lot of equity in my house and I go to a bank and I get a home equity loan for $25,000, the bank's going to hand me $25,000 as a home equity loan. I start paying interest on that entire balance right away, and then I have prepayment or repayment terms with the bank. That's a home equity loan. That is very different from a home equity line of credit. A HELOC, sometimes they're referred to as HELOC, home equity line of credit. A home equity line of credit is simply a line of credit set up that I can draw off of anytime I want to. So if I go to my bank and say I want a $25,000 home equity loan, they give me the full amount. If I go to my bank and say I'd like a $25,000 home equity line of credit, they'll approve me for that, but I don't take the money out right away. The money sits there. It's a line of credit. It's money I can draw off of whenever I want to. So if I decide one month I need some extra money in my checking account, I can draw 500 or 1,000 out, any amount I want up to that 25,000. But I only pay interest on the money that I've pulled out of the bank. So I'm not paying interest on the entire balance right away. So remember those differences between the home equity loan and the home equity line of credit. I want to wrap up our podcast here for financing with two different types of foreclosure. You want to know the distinction between these two for your exam. So in the marketplace, a lender may have to use judicial foreclosure, or they may be able to use non-judicial foreclosure if a borrower is in default. So what are the differences between the two? Judicial foreclosure. That means that when the borrower defaults, the lender has to go to a judge. Judicial. Has to go to court to get permission to foreclose on the buyer. When does that occur? Test alert here. That occurs when there is no power of sale clause in the mortgage that the borrower gave the lender in the beginning. If there is no power of sale clause, then the lender has to go to court to get permission to foreclose. And that leads us right into what is non-judicial foreclosure. Well, non-judicial foreclosure means the lender does not have to go to court. And why do you suppose the lender doesn't have to go to court? Which clause is in the mortgage the borrower gave the lender? The power of sale clause is in the mortgage, in which the borrower says to the lender, if I'm in default during the terms of this mortgage loan, I give you permission, I as the buyer give you, the lender, permission to foreclose upon me. That's the power of sale clause. Think of it as permission to sell, permission to foreclose. It's the permission clause in the mortgage. So if the power of sale clause is in the mortgage, the lender does not have to go to court to get permission to foreclose. And that power of sale clause is used in both mortgages and deed of trust, both in lien theory states and title theory states.